Hello, so just a quick video on the fact that I bought Nebius at around $100 a share a couple of days ago, and I'll tell you up front, my first sell zone is going to be around $130. Not because I think the story is necessarily going to end there with the company, but because that's where I think the short-term euphoria for this company meets the fair value. I just want to make a quick video to show this is why I basically bought it in the first place and why it's not even profitable yet. I think it's one of the most interesting plays in the entire AI kind of infrastructure change. So everyone's already heard about the headlines of Microsoft signing a $17 deal. I think it's really important just to highlight that Nebius is actually like the landlord of AI compute. They own data centers, buy the GPUs directly from NVIDIA and rent the capacity out. And Microsoft is doing the same thing, but they're also looking at hiring Nebius over the next years to help them, I guess, diversify. I basically bought this company for one kind of simple reason, and that's because it sits at this kind of intersection between two main megatrends, and that's basically that AI demand is exploding and infrastructure is not able to keep up. There's a global shortage of GPU capacity. Every major AI company is fighting for that compute. Nebius is one of the few independent actually building new capacity at scale. They're doing it fast too. The Microsoft deal, as I mentioned earlier, should lock in a roughly $3 billion a year over the next 5 years anyway, and that's guaranteed utilization, isn't it? So instead of chasing profitability now, they're pouring everything into growth, building out New Jersey, expanding Finland, securing chips, and tripling power capacity. To me, that's pretty much classic early stage Amazon logic, isn't it? Dominate first and monetize later. Plus they have an angle that no one else does, sovereign clouds. They're European based, which means they can serve governments and regulated industries that don't want to put their data in the US, which obviously becomes a huge tailwind as data sovereignty kind of rules tighten, as they no doubt will. So at $100 a share, Nebius was roughly a $20 billion company. They're still loss making, so I'm valuing it on forward revenues, not earnings. By the end of 2025, they should be around 1 billion ARR. And with Microsoft ramping plus new enterprise clients, 2026 revenues could hit 1.5 to 2 billion. If you apply the 10 to 12x EV sales multiple, normal for a hyper-growth infrastructure name, you get an enterprise value between 18 to 24 billion, right around what it trades at now. So my base case is simple. I'll take partial profits around $130. That's roughly a 30% move from my entry, and let the rest ride in case we see a full Microsoft ramp or another big contract come in. The story from here is all about execution. Finishing the New Jersey build for Microsoft, signing a second or third major client, ideally outside of the US, keeping cash burn under control while expanding capacity. If those three boxes get ticked, the markets will start valuing Nebius as a infrastructure utility, not as a speculative AI stock. So before we wrap it up, let's just talk about the risk, because this isn't necessarily a free ride. Nebius is still within that heavy build out phase. They're spending billions on GPUs, land and power, all before a dollar of that new capacity really pays back. It's capital intensive, and that makes the stock very volatile. Second, they're still cash flow negative. Profitability is probably a couple years away, maybe longer if they keep expanding aggressively. That's fine in a growth market, but it becomes a bit of a problem fast if sentiment or liquidity dries up. Third, they're still highly dependent on one customer, Microsoft. It's a great customer to have, of course, but it's a concentration risk. If Microsoft slows its AI investments or renegotiates capacity, that'll hit Nebius, of course, directly. And finally, the macro picture. AI spending cycles will ebb and flow. If the Fed stays tight or tech budgets compress, you'll see it reflected in all of these infrastructure names. That said, my outlook is still positive. Nebius is building the physical foundation of AI, the data centers, the cooling, the power backbone. As long as demand for compute keeps outpacing supply, these assets only become more valuable over time. I'm long from around $100. I'll take my first trim near 130. That's where short-term momentum likely meets fair value, and I'll reevaluate from there depending on how execution looks. But this is one of those companies where if they just keep building and delivering, the market eventually stops seeing it as a speculative AI stock and starts treating it like an essential infrastructure.